What is going on, everyone? I hope you are all having a fantastic day. So I think most of us would agree that the past month for a majority of cryptocurrencies has not been very good in terms of heading to the moon. But regardless of whether you are diamond handing it and holding on to the end, or if you're starting to reconsider and thinking about moving away from crypto, there are some huge advantages and ways to save a ton of money by actually selling those cryptocurrencies that are currently at a loss. So today I want to break down my entire strategy and share with you a way that you can actually take advantage of those losses and save a lot of money by selling your cryptocurrencies and turn that into savings on your taxes. All right, let's jump right into it. Okay, so I'm sure some of you have already picked up on what I'm talking about here, but essentially I'm talking about a very common investing strategy called tax loss harvesting. Now, you may have heard me mention this before in my review on platforms like Wealthfront or Betterment, and that's because those platforms actually automatically implement a tax loss harvesting strategy into your investment portfolio. And essentially what tax loss harvesting is the strategic selling of certain assets that may be down and utilizing those losses in order to offset the taxes that you owe on your gains from other assets. I know there's a lot to unpack in there, so what the heck does this actually mean? Well, basically, let's say you have one cryptocurrency that you were up $1,000 on, meaning if you sold it today, you would owe taxes on that $1,000 in profit. Well, instead of owing taxes on that full $1,000, let's say you have another cryptocurrency that is down $500. Well, that loss of $500 can actually be subtracted from your $1,000 gain from your other cryptocurrency, and now you will only owe taxes on the $500 in profit. But the main thing to keep in mind is that those losses can actually be used to your advantage in order to offset the taxes that you owe on the gains from other assets. And what's even cooler is if you've had a really bad year and you've lost more than you've earned in your investments, then you can actually deduct up to $3,000 of that net loss against your income for the year, and then roll any remaining losses forward into the future year and continue saving money on your taxes in future years based on this year's losses. So let's say you had the same cryptocurrency that was up $1,000, but you had 5 other cryptocurrencies that were each down by $1,000. Well, that would mean that you made $1,000 and you lost $5,000, meaning you had a net loss of $4,000 for the year. So you can deduct up to $3,000 of that on your taxes this year, and the remaining $1,000 can then be rolled forward to next year. Now, before we talk about the specific advantages of doing this with cryptocurrencies, I do feel that it is important to mention that this does not mean that you should go and try to lose money on certain investments. Nor should this be your justification for putting your money into really volatile investments like cryptocurrencies. Obviously, losing money is bad, and yes, you are getting some tax savings and using that bad situation to your advantage. However, you're still losing money on that investment, and unfortunately, no amount of tax savings is really going to make up for that full loss. Okay, but what in the world does this have to do with cryptocurrencies in particular? And what is the main advantage of doing this sort of thing with cryptos? Well, the first huge advantage is that, at least for the time being, the IRS views cryptocurrencies as a property and not as a security like they do with stocks, ETFs, and other forms of investment. Now, that probably doesn't sound like a big deal, but what this means is cryptocurrencies do not fall under the rule that is known as a wash sale. Now, you may have heard of a wash sale before, but without boring you to death, basically, this is just a rule that is in place that says you can't sell a stock just to get the tax loss harvesting advantages and then immediately rebuy it at the same price. For example, if I have some Apple stock and I'm down $1,000 on that investment, then if that wash sale rule was not in place, I and everyone else would then just go ahead and sell that stock for a $1,000 loss, get that deduction on my taxes, and then immediately rebuy the stock at the exact same price. So as nice as that would be, unfortunately that is not allowed with securities, and you have to wait at least 30 days before repurchasing that particular asset. But since cryptocurrencies are not categorized as a security, they do not have to fall under that wash sale rule. And that is why what we're talking about today applies to not only those of you who might be looking to get away from cryptocurrencies, but also those of you who are diamond handing it and holding on to the moon, because even if you're just down for the moment, those tax advantages are definitely there for you. And even if you plan on rebuying, again, it doesn't fall under that wash sale rule, so you can just go ahead and repurchase. Now, before going forward with this, I do want to clarify that this is not tax advice, legal advice, or investment advice, or anything like that, and I'm simply sharing with you the public information and policy that can hopefully help you save some money if you are currently down on certain investments. Now, as if that whole wash sale loophole wasn't enough, the other ridiculous advantage that I cannot believe is actually a thing with the IRS is they actually allow you to specify what groupings of cryptocurrencies you are actually selling. Now again, I know this is getting a little bit confusing and that probably made no sense, but let's say you bought $1,000 worth of Dogecoin back in March and another $1,000 in May when it peaked. Well, what this means is despite Dogecoin's recent pullback, your initial investment for March would still be up a significant amount, while your second investment of $1,000 in May would actually be down a significant amount. So if you looked at your total Dogecoin investment, you would actually be up and you would owe taxes if you sold. But with this loophole, you can actually say that you are specifically selling the Dogecoin that you purchased in May that is currently at a loss, and then you can use those to offset the gains that you have on other investments. Again, I'm sorry that this is getting a little bit in the weeds, but I highly recommend that you rewatch this a few times, because when it clicks, it's honestly hard to believe that these rules and loopholes actually exist. Okay, so all of this is cool, but as you can probably tell, there's a lot of gray area here, so how can you actually implement this into your own investments and tax strategies? Well, first, what's really important is to always get a true tax professional in your corner who can actually go over your specific situation and give you professional advice. Again, I'm just sharing with you the strategies that I have used and information that is readily available to learn about online, but that does not mean that you should ever take tax or investing advice from me or anyone else on the internet. There's a reason that there are certifications and regulations around who is actually a true tax professional. And if you want to save as much money as possible on your taxes, whether that be cryptocurrencies or just everything across the board, then you want to have one of those individuals in your corner. Now, the other really important thing to keep in mind here is, yes, there is a lot of gray area when it comes to taxes and cryptocurrencies, and the rules and regulations surrounding this sort of thing could change at any moment. The wash sale rule that we talked about earlier is a great example of this, since cryptocurrencies definitely fall into that gray area since they are classified as a property and not a security. So with stocks and ETFs and other securities, the rules are very clear and it's really easy to interpret the law that is written about the wash sale rule. But with cryptocurrencies, they're technically not a security, so no, it doesn't fall under the wash sale rule, but there are other regulations like the economic substance doctrine that basically is the IRS's attempt to avoid this sort of thing, because at the end of the day, there are only two things that are guaranteed in life: death and taxes. Sorry, that was a little bit dark, but my point here is you definitely want to be careful with this sort of thing and do a ton of research and get a professional's help, because while we all want to save as much money as possible, at the end of the day, the IRS is going to get what is owed to them, and you are going to sleep so much better at night if you know that you're not trying to pull any shady business that falls into that gray area when it comes to your taxes. So I would love to know what your cryptocurrency tax strategy is and whether you plan on holding and not worrying about this sort of thing, or if you think you will try to implement a tax loss harvesting strategy with your crypto investments. As always, if you did get value out of this content and you want to help support me, it would mean a lot to me if you would hit the like button, subscribe to the channel, and share this video with someone who you think would get value out of this content as well. And as always, thank you so much for taking time out of your busy day to watch my video. It really does mean a lot to me. Take it easy, and I'll see you in the next one.